Welcome, empowered investors, and greetings from Taipei. Yes, I've been in Taipei for the past several days. It's been a nice adventure exploring around. I did some touristy stuff today, and it is obviously late here. It's morning where you are, probably. We've got listeners in 189 countries worldwide, but so many of them are in the Western Hemisphere. So probably for most of you, it's morning time. But I'm about to go to bed, and I am wearing my bathrobe. I know you think, what is Jason doing? Is he trying to be Hugh Hefner? Certainly not. That's never been my style. You know, the guy that always wore the bathrobe and the slippers around, right? Anyway, I wore this outfit for a couple of our Empowered Investor Pro calls because those are in a crazy time zone for me. And I'll be back in the US in just 8 days. I'll be back in the US to host our collective mastermind event in Texas. So that is where I will be. But until then, I'm on my way to Japan and then South Korea. I'm leaving out of South Korea. So that is the plan. Remember all the shows we've done where we've talked about modern monetary theory, otherwise known as MMT. And we've had some really well-known guests in the MMT world on the show in the past. And MMT overall is kind of a fantasy. It doesn't work, but it has a few elements of it that are absolutely brilliant. And in the MMT theory, one of the things those proponents, usually proponents of MMT, talk about is how the US creates this incredible circular system where you earn your money in US dollars, you pay taxes in US dollars, you spend in US dollars, you pay debts in US dollars, and by taxing, they create demand for US dollars. Well, this same MMT theory that is done on an individual basis, or I guess inside the country basis, is also done on a world basis. And you can see, as Michael Hudson, the well-known economist, is talking about it here on this video, you can see that this is a good reason that the rest of the world would be really upset with the United States. And you know, it's hard to fault them for that. They have a reasonable complaint. But what he doesn't tell you in the video is all of the great things the US has done for the world. So on balance, you have to balance this out. Okay? Yes, under Bretton Woods, and the US basically took over the world monetary system. It also agreed to do some things in exchange. Remember the Marshall Plan? Did you notice how the past many decades since then, the US has been the policeman of the world, right? So there are definitely things that the US has done to earn that right, or at least to trade privilege for privilege, right? To trade contribution for privilege, okay? It's not as black and white. You know, you want to bash the US, and then there's the people that give the US too much credit. I'm kind of in the middle. It's like the Tao, right? You know, it's the Zen way of the middle path. And there's just a balance to this stuff. And you never seem to hear the balance, which drives me crazy. You only hear one side or the other. You hear the US haters with their side, you hear the US patriots with their side, and you never really hear the truth, which is somewhere in the middle. But here is one of the sides where it is definitely not in the middle. But just notice the brilliance of this system, because it really, really, really is quite brilliant. Okay?
Makes African and third world debt different from the American debt. Number one, America is never going to pay its debts. It doesn't have to. Its debts are in its own currency. We can simply print it. The African debt is not in its currency. The African debt is in US dollars. Africa has to earn the US dollars. The only way it can earn the US dollars is not to be assassinated for growing its own food and becoming independent and doing something that the United States does not like.
Okay, so the same is true of all of us as individuals, if we're Americans, right? Because we have to earn our money in US dollars and then pay the IRS in US dollars. Well, Actually, that's not quite true. We don't have to earn it in US dollars. We could earn it in any currency. But in order to pay our tax obligation and not go to prison, we have to convert whatever currency, Japanese yen or Brazilian real or Mexican pesos, whatever it is, we have to convert it to US dollars because the IRS will only accept US dollars. So by having a taxing authority, they create demand for their paper money, for their fiat money. It's really quite a brilliant system. It's absolutely brilliant. And by creating the Bretton Woods system, which we have definitely seen a lot of pressure, a lot of leaks in that ship lately, right? And that'll probably continue to happen. But it's a really quite a brilliant thing. You got to give them credit where it's due because they've done it on an international scale and a domestic scale.
The principle underlying the foundation of the World Bank, the International Bank, IBRD, is that no country should grow its own food. Africa and the third world should only grow export crops. In order to have an oversupply of cocoa and other tropical raw materials, to keep down the price, they must buy their grain from the United States or Europe, so that if they do something that we don't like, we can do what America tried to do to China in the 60s. We can sanction them. We can say, we're going to starve you. We're going to not export any grain to you. So owing their foreign debt in dollars means that they have to somehow sell something that the United States wants, not what they want.
See, a lot of people have asked over the years, and we've been talking about this for a long time. I've mentioned it ever since I read a really famous article on this back in, I don't know, I talked about it on a show probably in 2007-ish, somewhere around there, right? Many, many years ago. And it was this well-known article. I can't remember the name of it, but it basically outlines why does the US need to tax when it has the inflation tax. If you have a central bank and you can just create fiat money out of thin air between the Treasury and the central bank and that unholy alliance between the Fed and the Treasury, right? If you can just create this money out of thin air, why do you need to tax the people? You're taxing them through inflation. Well, here is the reason. Because you've got to create demand for your currency. That is the brilliance of the circular system. And they've done it on a global scale, and they've done it on a domestic scale, as much as people may not like it.
I think the most evil organizations in the world today are the World Bank and the International Monetary Fund.
So there you go. Just thought that was interesting. Wanted to share it with you. So before we get to our interview portion with the driver in Cambodia, let's take a look at two properties, a good one and a bad one. So this one is the no thanks deal. Now, why is it the no thanks deal? Well, it is in the Denver area. Now, this is an area where we used to recommend properties because we used to have great properties many years ago. And many of you listening to this show became very wealthy taking our advice and buying properties through our network years ago in Denver. But it no longer makes sense. Yet here is a competitor of ours selling these properties in that market. Now, here's the kind of deal you'll get if you go through our competitor. You'll get this property that is just over 1,300 square feet for $480,000. That's a lot. That's $347 per square foot, and the monthly rent is only $2.17 per square foot. You can already see the problem here, folks. You're going to have to put $125,000 into this property to buy it with a 75% LTV. The rent is $3,000 per month. That's the projection. It's a nice new house. I'll give them that. Problem is, it's just about $100,000 too expensive. It's just too expensive to make sense. So let's look at page 2 of our pro forma here. And remember, one of the things you want to do to become a good real estate investor is you must standardize your data. This is one of the very good decisions I made back in 2004. And we do that with Property Tracker. You can get a free account. Just go to propertytracker.com, get your totally free account, no strings attached. Yes, there is a premium account. You can upgrade if you want, but you really don't need to because the free account is quite great. It's quite a generous free account. So get your free account and you can do these performas for yourself. And when you do them yourself, you can change the assumptions, you can play with the numbers, and you can see the outcome of changing these assumptions. This is the thing that will make you a really, really good investor. So go get your free Property Tracker account. Do not pass go. Do not collect $200. Go get a free Property Tracker account at propertytracker.com. Again, no strings attached. It's a great deal. It's free. Okay, so here are all your expenses on this property and your mortgage payment, debt service, and so forth. And your monthly cash flow is projected at negative cash flow, $317 per month, $317 per month, or close to $4,000 a year negative cash flow. We've got all the same assumptions here. 6% appreciation, 8% vacancy rate, a lot of the competitors. By the way, this is not their pro forma. We put it into our pro forma to standardize it so you can compare apples to apples, because we're going to show you another property that does make sense here in just a moment. So I do want you to pay special attention to this because we're going to compare it to the other one in a moment. This is the debt coverage ratio. It's 0.85. Now, being at 1, when your debt coverage ratio is 1, that means you are at parity or at par. You are at a break-even scenario. Here, you're below break-even. You are at a negative, dangerous scenario. In fact, there is no DSCR lender. What does that mean? That means debt service coverage ratio lender, DSCR, that would loan on this property based on these terms, because they know you are going to get in trouble. The likelihood of you getting in trouble with this property is extremely high given that debt coverage ratio. Okay, now your cash on cash return is negative 3%, negative 3%. But amazingly, income property is such an incredibly resilient asset class. With the leverage, with the appreciation, even with negative cash flow, you could still get a positive return on investment. Now, many of our properties will have similar positive returns on investment, all things considered. However, that doesn't tell you everything. The reason will become clear to you in just a moment when we look at the good property. So this guy, if you're watching on video, if you're not, you're getting it all listening pretty much, okay? This guy that I made on AI says no thanks to this deal. He says no thanks. But on the next one, this is one of our properties that you can find at jasonhartman.com. This sexy lady that I also made on AI says yes. She says yes. So I thought that would be pretty funny. Okay, this property is in Nashville. Now, Nashville is Denver 10 years ago, maybe 12 years ago, right? Nashville is a good, desirable city. I am so pleased that we have properties in Nashville finally. For many, many years, we've been trying to get Nashville to work, and it hadn't worked very well, but we did find some properties. We've got a small number of them, but Nashville's pretty great with these. All right, so this one, 1,736 square feet, $449,990, 125,000 in, or 126,000. It's about the same. And here you've got a projected rent at $3,200 per month. But take a look at what happens on the next page. Your debt coverage ratio here, based on the same amount down, okay, 25% down, but you've got an incentive on the financing here that brings it to only 4.99%. So a buy down from the builder. This is also brand new construction, just like the other one. So apples to apples, they're both brand new construction. Now, this one, you have got a cash on cash return projected at 5% positive, whereas the other one was 3% negative. So there is an 8% delta in the cash on cash return projections on these two properties. This one, the overall return on investment is projected at 31% annually, and you've got similar assumptions, but this one does have a rent guarantee, so it gets a little better assumption on vacancy rate. Okay, so talk to your investment counselor about this. And again, with a free property tracker account, you can just change any of these assumptions. You can change the mortgage, you can change the price, you can change the appreciation rate, you can change whatever the heck you want. You can change the insurance cost. Everything is changeable. And it only takes about 5 minutes to do these performas. And once you get good at it, it takes you 3 minutes to do a performa, maybe even 2 minutes. And you'll get this nice, beautiful report that looks just like this. I cut it in half to put it on 2 slides for you to make the numbers big and easy to read. It's normally just on 1 page, and it's fantastic. Okay, here your cash flow is projected at $577 a month positive cash flow. And again, I went over the numbers with you. The debt coverage ratio, though, on this one is positive. It's 1.32. Remember, 1 being break even. This is much higher than break even. So the likelihood of getting into trouble with this property is extremely low, given that very good debt coverage ratio. So the reason I'm talking about debt coverage ratio today is I know that a lot of investors are really, really conservative. And the interesting thing about investing is sometimes being super conservative can be super risky. I know it's counterintuitive, but if you're conservative, the number you want to kind of focus on is debt coverage ratio. Because again, that is the how likely is it that I'll ever get into trouble with this property ratio? That's the debt coverage ratio. Okay, so that's why I'm talking about it a little bit today. All right, I hope that's helpful to you. Remember, we've got Empowered Investor Live. We haven't had, by this date, we will not have had a live conference for about 15, 16 months. This is coming up in Irvine, California, my old hometown for many, many years. I built a big career in Irvine and Newport Beach for many, many years in traditional real estate. So I'm back in my home stomping grounds. It's April 4th through the 6th, Empowered Investor Live. It's a 2.5-day conference. Save the dates. We will have a ticket sales website for you soon, and we're going to have an early bird that'll blow your mind. Early bird deals. And I know the vast majority of you just buy those early bird tickets right away. That's the smartest thing to do because the deal never gets better than the early bird deal. All right. So save the date, April 4th through the 6th for Empowered Investor Live. We have a lot of fun at these conferences. We drink a little bit. We have levity. It's really fun. We have tons of education. We have an exhibition hall with all sorts of trade show booths, so you can meet a whole bunch of different vendors and suppliers of all the important products to make your real estate portfolio really, really work well. It's just a great time. We'll have a band on Saturday night. We'll do some dancing and cut a rug and tear it up, and it's just a lot of fun. So it starts Friday afternoon at 1 p.m., right after lunch. So grab a bite to eat and then join us at 1 p.m. on Friday. We'll go into the evening. We'll have a cocktail party that night, and then all day Saturday, and then Saturday night we'll have the band, and then all day Sunday. And we'll end Sunday at about 6 p.m.